Hi again. In this lesson, we'll be talking about another gap setup that is to be used only in downtrends. This is the setup. When we are in a downtrend, the opening bar gaps up and is a bearish bar. We short the low of that minus a small filter. Now, if trading Nifty, 1.5 points is a good filter to keep. Now, if you notice, our gap trades have always been short selling. The first setup was a short sell as well. So is this one. This is because people panic sell more often than phases of, say, a greedy buy. Let's see some real examples of this setup, but this time we'll see it in. Now, as you can see, Nifty was already in a downtrend and the opening bar of the day gapped up and closed red. As soon as this happens, we place a short sell order here and wait for our order to be triggered. The markets fell, triggering our short order, and in a few hours, the market continued to slide and achieve our target. Okay, let's see another example of this setup in action. Now, on the 17th of July, Nifty was in a downtrend, as evidenced by the lower swing highs, and on the 18th, the market gapped up. The opening bar was red too. That's all we need for a confirmation of this setup. We can place our short sell order 1.5 points below the low of the opening bar. Remember, you need the bar to close before you actually do this. This trade worked out pretty well. The markets fell 42 points, so that's 0.8% on an intraday basis. Now let's move on to another example. Now you'll notice that they all seem the same, and they should. That's what a setup is. It should be photocopies of each other. Having too much variation means you're not following a strict rule system, and I think our rules are pretty simple. A setup should be as black and white as possible and avoid areas of gray as much as possible. Here we have Nifty in November. We were in a downtrend as evidenced by the lower swing highs, but on the 20th, we gapped up. Now remember, it's very easy to be swayed by news at this point. Downtrends, gap ups within downtrends happen because of good news usually. They could be global news or very specific news on one of the biggest constituents of Nifty. You have to stick to your plan. In this case, we had a gap up within a downtrend and the opening bar is red, as you can see here. In the next bar, you can see that the market tried to push up, but you need to follow your plan. We keep the sell order at the low of the opening bar, waiting to get in, waiting to short sell. This happened on the third bar of the day. That's the third hour after the markets opened. And you can see that it triggered and the markets collapsed. As I said before, panic selling happens more often than phases of greedy buys. Now, this particular trade was pretty good. Although you would have exited at 2R, Nifty had fallen 142 points on an intraday basis. Now I know what you're probably thinking. You're probably thinking whether we should hold on to our winners and make money all the way down, maybe get the 100-point days, or should you exit at 2R? That's a fixed target. Now, exiting at a fixed target usually means lost profits on days like this, and there is nothing you can do about it. However, studies we have ran show time and time again that for more consistent profits, you should stick to a target-based approach. If you have the patience to ride winners and wait weeks on end for huge winners like this, then maybe trailing stops should be your approach. You would obviously trail at latest swing highs in that case. But if you're new and you're doing this for the first time, then stick to fixed targets. It's simple and it gives more consistent returns. I hope you found this lesson interesting. It was very simple. If you have any questions, don't forget to put it in the discussions area below. I'll see you in the third and final installment of this course. See you then.